Hey there, and welcome to the Deep Dive. You know that feeling when you're swimming in a vast ocean of information, trying to get truly well-informed without getting completely overwhelmed by, well, just the sheer volume?
Uh-huh. It's a lot out there.
Exactly. That's precisely what we're here for. We take a stack of articles, reports, and cutting-edge research, just like the comprehensive analysis you've shared with us today, and we meticulously extract those crucial nuggets of knowledge.
Those aha moments.
Yes, those genuine aha moments to give you a powerful shortcut to understanding. Today, we're diving deep into an absolutely fascinating company. For many, it operates largely behind the scenes, yet its influence touches so much of our daily lives. Azelis Group NV, traded under the ticker AZE.BR.
Right. Not exactly a household name, but definitely impactful.
Definitely. And this isn't just about stocks and finance, It's a deep exploration of a unique and highly resilient business model that's thriving in a complex, vital, and ever-evolving industry.
It really is.
Our primary guide for this deep dive is a comprehensive investment analysis report. It's packed with intricate details on Azelis' strategy, its impressive performance, and the competitive landscape it navigates.
Indeed. Our mission today is to go far beyond the surface-level headlines and truly understand the intricate mechanics that drive Azelis.
Get under the hood.
Exactly. We'll meticulously explore their distinct approach to the specialty chemical and food ingredients distribution market, analyze the sources of their financial resilience, and unpack why the market's current perception of the company might be missing some crucial underlying elements.
Okay.
For you, this isn't merely about understanding a potential investment. It's about grasping how profound value is created in highly specialized global supply chains, and also how agile, strategically focused companies effectively navigate the various economic cycles that inevitably come their way.
So whether you're meticulously prepping for an important meeting, diligently catching up on the dynamic shifts within this particular market, or perhaps just insanely curious about what makes a high-quality compounder tick.
And by compounder, we mean...
Right, good point. By compounder, we mean a company that consistently grows its earnings and strategically reinvests those profits to generate even more growth over the long term. A real value creator.
Got it.
So if any of that sounds like you are absolutely in the right place. Let's unpack this. Okay, let's start right at the foundation. When you hear the phrase chemical distribution, what comes to mind? Big trucks, vast warehouses.
Yeah, logistics mostly. Moving stuff from A to B.
Right, just moving bulk goods. But Azelis, as our source highlights right at the outset, explicitly states it does much more than move goods. What exactly does that mean for their operations? How is their business model fundamentally different from, say, a straightforward logistics company?
Well, what's truly fascinating here is that Azelis very deliberately positions itself not merely as a distributor, but as an innovation service provider.
An innovation service provider. Great.
Yes, within the highly specialized chemical and food ingredients industry. They aren't just transporters or brokers. They are a critical intermediary that actively creates profound value for both sides of this complex supply chain.
Both sides meaning?
Meaning the manufacturers, the principals, and the end users, the customers. So on one end, they seamlessly connect an incredibly diverse base of over 2,800 supply partners, which they call principals. These are the chemical manufacturers.
2,800, wow.
Yeah, it's a lot. And they connect them with a highly fragmented customer base. We're talking more than 62,000 formulators and end product manufacturers.
62,000 customers. That's incredibly fragmented.
Exactly. And spread across 65 countries. So their core value proposition extends far beyond simple logistics. It's deeply anchored in offering what they term a lateral value chain of complementary products.
Lateral value chain, meaning?
Meaning they can provide a customer with not just one ingredient, but all the related specialized ingredients they might need for a complex formulation. Think shampoos, coatings, specialized foods.
Ah, okay. So like a one-stop shop for related chemicals.
Pretty much. And crucially, they provide a deep well of technical expertise that helps customers actually use those products effectively. That's the innovation service provider part.
Okay, so let's break that down. How does it work for the principals, the manufacturers?
Right. For their principals, Azelis provides an indispensable outsourced sales and marketing channel. Imagine you're a large chemical manufacturer.
Okay.
Trying to directly reach thousands of smaller customers, each needing maybe small quantities or specific advice. It would be incredibly inefficient, cost prohibitive, really.
Right. You'd need a huge sales force, tons of technical support.
Exactly. So Azelis stepped in. They offer deep market intelligence, unparalleled access to this vast, fragmented customer base. They effectively become an extension of the principal's sales force.
But more specialized, more local.
Precisely. With a broader reach, deeper local insight, often saving the manufacturer significant overhead costs.
Okay, that makes sense for the manufacturers. What about the customers, the 62,000 formulators?
For them, Azelis acts as a true one-stop shop. Instead of sourcing individual specialty products from maybe dozens of different manufacturers.
Which sounds like a nightmare.
It would be. Azelis provides access to a broad, curated, and often complementary portfolio, but it absolutely doesn't stop there. They also offer crucial formulation advice.
Formulation advice, like how to mix things.
Exactly, and extensive technical support. This significantly reduces the customer's own R&D complexity, their procurement headaches.
Allowing them to focus on their actual product.
Precisely. They can focus on core product development, knowing they have a knowledgeable single partner for their diverse ingredient needs. The key takeaway here is Azelis transforms raw ingredients into applied solutions. They're a crucial bridge between supply and innovation.
So it really is far more than just logistics. It's this embedded innovation, integrated services. And you mentioned that deep technical engagement gives them an edge. Our analysis mentioned that their network of labs is a cornerstone of this, a key competitive moat. But in a market where maybe others just compete on price, what stops someone else from just building labs or poaching their talent? What makes it so sticky for Azelis?
That's a really perceptive question. The answer really lies in the sheer depth and scale of their technical investment. It creates substantial barriers to entry and, importantly, strong switching costs for customers.
Okay, switching costs.
Yeah. Azelis' answer to fostering these sticky, long-term relationships is this extensive network over 70 application laboratories and research centers strategically located around the globe.
70 labs, that's significant.
It is. And these facilities aren't just for basic quality control or simple sample analysis. They are sophisticated innovation hubs. They're staffed by industry and technical experts who provide really in-depth formulation support, detailed technical guidance, even collaborative co-development services with the customers.
So they're working alongside the customer's R&D team.
Often, yes. This deep technical engagement is what truly differentiates them. It effectively embeds Azelis directly within their customers' product development processes.
Right.
It means they're not just selling a chemical product, they're actively helping a customer innovate, solve complex formulation problems, maybe bring new, specialized products to market faster, more efficiently.
Can you give an example?
Sure. Think about, say, a personal care company trying to develop a new, sustainable, maybe sensitive skin shampoo. Azelis' labs could help them identify the right bio-based surfactants, optimize the pH, ensure stability, even conduct preliminary performance testing.
Stuff the customer might otherwise have to invest heavily in themselves.
Exactly. Tasks that would otherwise require significant in-house R&D investment from that customer. And the success of this isn't just an internal claim, it's externally validated. They've won numerous prestigious industry awards like the Gold Award at In-Cosmetics Asia, the 2023 Ringier Technology Award for Innovation in Personal Care.
So not just internal PR, the industry recognizes it.
Yeah, precisely. These aren't merely accolades. They demonstrate that the industry itself recognizes the concrete technical solutions and the tangible value Azelis provides. This is essentially Azelis' innovation flywheel, you could call it.
Flywheel, how so?
Well, the deep technical expertise fuels robust customer relationships. These relationships generate invaluable market intelligence, which they can feed back to principals. And this whole ecosystem then makes Azelis an attractive partner, which in turn fuels strategic acquisitions that expand their capabilities even further.
Ah, I see. It's a self-reinforcing loop that continually strengthens their position. That's powerful.
Very. It builds real, defensible, competitive advantages.
Okay, that makes a lot of sense.
Well,
Now let's zoom out a bit and look at their actual business breakdown. Our sources divide Azelis into two primary end market segments: life sciences and industrial chemicals.
Correct.
How do these segments balance each other out, especially when, economic winds inevitably shift? Seems like a smart way to diversify risk.
It is. This diversification is absolutely key to Azelis' resilience and their impressive ability to navigate various economic cycles. The two segments provide truly complementary characteristics.
Okay, tell me about life sciences first.
Right. First, you have life sciences. This is their largest and arguably most resilient segment. It accounts for approximately 63% of their total revenue in fiscal year 2024.
63%.
So the majority, the clear majority. And it primarily serves markets with what we call non-discretionary demand characteristics.
Non-discretionary. meaning essential stuff.
Pretty much. Think about essential daily needs. Food and nutrition like specialty emulsifiers for plant-based yogurts or maybe flavor enhancers. Personal care products, things consumers tend to buy regardless of the economic climate, like advanced sunscreens or sensitive skin ingredients. And pharmaceuticals and healthcare providing critical excipients or active pharmaceutical ingredients.
Things people need, recession or not.
Generally, yes. The defensive nature of this segment was clearly demonstrated during the recent economic slowdown. In FY24, life sciences revenue actually grew by a solid 3.4%.
It grew, even with the slowdown.
It did, and an even more robust 4.7% if you look at it in constant currency. This growth was absolutely crucial in offsetting weakness they experienced elsewhere in the business.
A real anchor.
Definitely. And the company's recent M&A activity shows a clear focus here. Acquisitions like Gilco Ingredients in the U.S., Vogler Ingredients in Brazil, they're deliberately strengthening the stable, high-growth segment. It acts as a predictable earnings ballast for the whole group.
Okay, so that's life sciences. What about industrial chemicals?
Then there's industrial chemicals. This represents the remaining 37% of their FY24 revenue. This segment is, well, by its very nature, more exposed to broader macroeconomic cycles.
More cyclical.
Exactly. It serves markets like coatings, adhesives, sealants, and elastomers, often just called CASE, used in everything from cars to construction.
Right. Things that slow down when the economy slows down.
Precisely. Also, lubricants, metalworking fluids, electronics components. As a direct result of global industrial weakness and that widespread customer destocking we saw, revenue in this segment did decline by 1.7% in FY24.
Okay, so that's where the weakness was.
Yes, with particular challenges noted in markets like China and Canada. However, the flip side is, as the industrial cycle inevitably turns and demand recovers,
Which it usually does.
this segment offers significant operating leverage and robust growth potential.
Operating leverage meaning.
Meaning, as demand recovers, a relatively small increase in sales can lead to a disproportionately larger increase in profit, because many of their underlying operational costs in this segment are more fixed. It's the powerful cyclical upside to the defensive stability provided by life sciences.
Got it. So life sciences provides that steady base, almost like a strong anchor in stormy waters. And industrial chemicals offers that significant potential for cyclical upside when the economy is really humming.
Exactly. It's a smart balance to mitigate overall business risk.
Okay. What about their geographic footprint? Do they spread their risk there too, or are they concentrated in just a few key regions?
No, they definitely spread it. Azelis maintains a remarkably well-balanced global presence. That's another crucial layer in their comprehensive strategy to mitigate risk from regional economic downturns or specific market challenges.
So where are they biggest?
Their largest region is EMEA, Europe, Middle East, and Africa. That accounted for 43% of their FY24 revenue. Performance there in 2024 was stable overall. And what's particularly notable is that it showed a significant return to growth in Q4, up a strong 5.3%.
Q4 24. That's interesting.
Yes, it suggests that EMEA might be at the forefront of a broader market recovery for Azelis, often acts as an early indicator, perhaps.
Great. And the Americas.
The Americas region has been a primary engine of growth for the company. It represents a substantial 36% of FY24 revenue. Even in a globally challenging year, this region delivered a strong 6% sales increase.
6% growth. That's strong.
Very strong. And this outperformance was significantly boosted by those strategic acquisitions expanding their life sciences footprint, particularly in North and South America,
Right.
tapping into robust consumer markets there.
Right, like Gilco and Vogler.
Exactly.
And finally, Asia Pacific.
Finally, APAC, or Asia Pacific, currently their smallest region, making up 21% of FY24 revenue. It faced some headwinds in 2024, with a 2% decline in revenue largely due to industrial softness, particularly in China.
That's strategically important long term.
Absolutely vital for long-term growth. Azelis has a clear focus on M&A-led expansion in APAC. They want to capitalize on the region's generally higher underlying economic growth rates, think growing middle class, rapid industrialization. That will fuel demand for specialty chemicals and food ingredients for years to come.
So putting it all together.
What this really means for your understanding is that this robust segment diversification, combined with the geographic diversification, forms a core part of their comprehensive risk mitigation strategy. It provides stability through different economic conditions and offers multiple independent avenues for growth. It ensures that no single market or product category can completely derail their overall performance. Makes for a much more resilient business overall.
That makes perfect sense. A well-balanced, resilient structure.
Yeah.
That's a fantastic overview of what makes Azelis' model so unique, moving far beyond just logistics with their innovation and technical services. Very clear. But every company, no matter how unique, operates within a larger ecosystem,
Oh.
right? So let's talk about the playground they operate in. How big is the chemical distribution market itself, and what are the powerful forces driving its impressive growth?
Right. The market context is crucial, and this market is indeed substantial and currently experiencing strong structural growth, which of course makes it a compelling backdrop for a company like Azelis.
How substantial?
Estimates place the entire global industry at approximately USD 93.1 billion in 2023.
$93 billion. Okay, that's big.
It is. And what's even more compelling for companies like Azelis is that various authoritative market research reports project robust compound annual growth rates, (CERG), ranging anywhere from 4.2% to a significant 7.4% right through to 2030.
Wow, 4 to 7% growth per year. That's solid.
Very solid. This isn't just a static or mature market. It's a favorable industry backdrop that provides a powerful secular tailwind for all participants, and especially for those strategically positioned with value-added services, like Azelis.
Those are genuinely impressive growth numbers for an industry that might seem, on the surface, a bit mundane, maybe even boring to some.
Perhaps. But clearly there's a lot more to it than meets the eye.
So what are the big long-term trends propelling this market forward? This is where it gets really interesting, I think, because it shows how Azelis isn't just a passive player, but one that's actively benefiting from and maybe even shaping these powerful shifts.
Absolutely. Several key drivers are contributing to this sustained growth, and Azelis is very strategically positioned to capitalize on each of them, often actively shaping these trends through their own business practices, as you say.
Okay, driver number one.
First, there's the outsourcing imperative. Chemical manufacturers, especially the large multinational ones, are increasingly looking to outsource non-core functions.
Like distribution.
Exactly, including the complex distribution and technical sales of specialty products. For manufacturers, distributors offer a far more efficient route to market, particularly when trying to reach that large, highly fragmented base of smaller customers we talked about.
Right, the 62,000 Azelis customers.
Precisely. Imagine a massive chemical producer trying to manage sales, technical support, logistics to, say, a small artisanal soap maker in rural Italy, or a boutique cosmetics brand developing an innovative new product.
A logistical nightmare, as you said.
Absolutely. So Azelis steps in, handles that fragmented complexity. It allows the manufacturers to focus on their core competencies: large-scale R&D, efficient production. Azelis, with its comprehensive outsourced expert sales and marketing channel, is a direct beneficiary of this fundamental shift in industry strategy.
Makes sense. What's next?
Second, we're seeing a significant and growing demand for value-added services. As end products become increasingly complex, think sophisticated formulations in modern pharma, advanced coatings, functional foods.
Things are getting more specialized all the time.
They really are.
Mhm.
And as regulatory landscapes around the world tighten, customers need more than just a product delivered to their door. They are actively seeking partners who can provide deep formulation expertise, precise application testing, maybe custom blending services, and crucial regulatory support to navigate complex compliance requirements.
That sounds exactly like what Azelis offers with its labs.
It is. This trend directly and powerfully favors Azelis' business model and its heavy, deliberate investment in its technical capabilities through that lab network. They aren't just selling ingredients, they're selling complete, integrated solutions.
Okay. Outsourcing value-added services. What else?
Third, and this is a major one for Azelis' aggressive growth strategy, is a fragmented market ripe for consolidation.
The M&A angle again.
Yes, the chemical distribution industry remains highly fragmented globally, particularly in emerging markets across Asia-Pacific and Latin America, where many small, local players exist. This inherent fragmentation creates a very long runway for growth through consolidation.
An opportunity for the big players.
Exactly. Well-capitalized, agile players like Azelis, along with peers like Brenntag and IMCD, act as natural consolidators. They strategically acquire smaller, regional players, rapidly expanding their geographic footprint, their product portfolios.
And integrating them onto their platform.
Right, integrating these smaller operations into a more efficient, globally connected platform. It's a key growth driver.
Okay, what's number 4?
Fourth, there's the rise of sustainability. This is a powerful, undeniable global shift. You see it everywhere.
Definitely. ESG is huge.
It is. Driven by evolving consumer preferences for greener products, increasing regulatory pressure for eco-friendly practices, corporate sustainability mandates, there's a growing demand for sustainable, bio-based, and eco-friendly specialty ingredients.
So companies need help finding and using these.
Precisely. Distributors that possess strong sustainability credentials and the technical expertise to help customers reformulate their products to meet these new demands are incredibly well positioned to benefit.
And Azelis is focusing on this.
Very much so. With their ambitious Impact 2030 sustainability agenda, things like reducing their carbon footprint, promoting sustainable solutions, and their top-tier ESG ratings from respected organizations like Sustainalytics and MSCI, they're clearly positioning themselves as a leader in this critical domain.
Which must help with big customers.
Absolutely. It allows them to meet the stringent procurement requirements of large consumer packaged goods companies, CPGs. It could even potentially benefit them with a lower cost of capital. It's becoming a tangible competitive advantage.
Okay, and the last driver.
And finally, digital transformation is actively revolutionizing the industry. The adoption of digital tools, advanced e-commerce platforms, intuitive customer portals offering real-time order tracking and product info, sophisticated data analytics for market insights,
Making things more efficient.
enhancing customer engagement, improving supply chain efficiency, creating entirely new sales channels. Azelis is actively investing in its digital capabilities to maintain a competitive edge, and we see the results. A remarkable 60% increase in active users on their digital portals in 2024 alone.
60% increase. That shows strong adoption.
It really does. Shows the value these platforms provide.
So what does this all mean for you, the listener?
It means Azelis isn't just reacting to these powerful market forces.
They're riding the wave.
They are, and in some cases helping shape it. They're actively benefiting immensely from these powerful long-term trends. They're leveraging these seismic shifts to build a more resilient, more growth-oriented, and ultimately more valuable business.
Okay, so Azelis is clearly operating in a growing market with strong tailwinds. They have a very distinct, value-added business model leveraging deep technical expertise. That's all clear.
Good.
But it's rarely a quiet landscape when there's growth to be had, right?
Yeah.
Who are their main competitors in this specialty distribution space? How does Azelis stack up against them? It sounds like a competitive arena.
It is. That's absolutely right. Even a structurally growing market has its leaders and challengers, and the specialty chemical distribution space is no exception. The global market, while fragmented at the local level, does feature a concentration of leadership among a few large, publicly traded companies. Brenntag is widely recognized as the global market leader in overall chemical distribution.
Brenntag, heard of them.
Right. They operate a dual model with both specialties and essentials, or commodity divisions. However, the most direct and relevant peers for Azelis are actually IMCD.
IMCD.
Yes, IMCD. And the specialties division of Brenntag. Because these companies share Azelis' laser focus on value-added services, technical sales, and innovation. Univar Solutions is also a significant competitor in the broader space, though they also have a more diversified portfolio, including commodities.
So Brenntag Specialties and IMCD are the closest comps.
Pretty much, yes, in terms of the model. And the strategic approaches of these main competitors are broadly similar. They center on a combination of organic growth and that disciplined M&A strategy to consolidate the market.
Everyone trying to buy up the smaller players.
To a large extent, yes. It's an environment you could describe as an oligopoly, where scale begets further scale. Being bigger benefits everything from sourcing relationships with principals, achieving logistics efficiency, and the ability to invest in sophisticated IT and digital platforms.
Creates a virtuous cycle for the leaders.
Exactly. Makes it harder for smaller players to compete effectively on a global scale.
It sounds like a tough crowd to compete with then. In a market where scale is so important, how has Azelis managed to carve out such a strong position and compete effectively against these established giants and focused players? Especially considering the big upfront investment needed for things like that global lab network.
That's a great point. Azelis has truly excelled in scaling its business to become a formidable competitor. They've reached a size directly comparable to IMCD, which is its pure-play peer in the specialty segment,
How do they scale so fast?
primarily through a highly active and agile M&A strategy. Their focus has been on what are often called tuck-in acquisitions.
Click-ins, meaning smaller deals.
Yes, smaller strategic purchases that add specific capabilities, expand their geographic presence into attractive new markets, or bring in new valuable principal relationships.
Yeah.
For example, an acquisition might give them niche expertise in, say, advanced battery materials, or a stronger foothold in a rapidly growing APAC market. The key here isn't just buying revenue. It's acquiring technical talent, intellectual property, established customer relationships.
Adding pieces to the puzzle.
Precisely. Azelis' success here demonstrates that executional excellence in M&A, the ability to identify, acquire, and seamlessly integrate these smaller entities, is a potent competitive advantage in this particular market. It lets them build scale and capability far faster than organic growth alone could achieve.
This picture of Azelis as a formidable competitor with a clear M&A edge is compelling. But, as they say, the proof is in the pudding.
Or the financials in this case.
Exactly, the financials.
Yeah.
Our analysis includes a direct financial comparison of Azelis with Brenntag and IMCD. What do these benchmarks tell us about Azelis' performance and its standing among its peers, especially when we look at profitability?
Right. This is where we see Azelis' distinct quality really emerge, particularly when you look beyond just top-line revenue and dig into the efficiency and profitability of their operations.
Okay, let's look at scale first.
In terms of scale, Azelis, with $4.2 billion in revenue in fiscal year 2024, is indeed directly comparable to IMCD, which reported $4.4 billion in FY23.
So, neck and neck with IMCD.
Pretty much. Shows Azelis has achieved substantial scale within the specialty segment. However, it's significantly smaller than the industry giant Brenntag, which recorded a much larger $16.8 billion in FY23.
Okay. Now, profitability, gross margin.
Right. Gross margin. All three companies exhibit strong gross margins. That reflects the inherent value-added nature of their services rather than just being commodity distributors. Azelis' FY24 gross margin of 24.5% is right in line with IMCD's 25.3% in FY23 and Brenntag's operating gross profit to sales ratio of 24.0% in FY23.
So all similar at the gross profit level.
Yes, pretty close, where they take the direct cost of goods sold into account.
Okay, but what about operating margin, EBITDA margin?
Right. The EBITDA margin, earnings before interest, taxes, and amortization, a key measure of operating profitability. Here's where it gets really interesting.
How so?
Azelis' adjusted EBITDA margin of 11.2% in FY24 is nearly identical to IMCD's 11.6% in FY23. Both very strong.
Okay, Azelis and IMCD are basically the same there.
Almost identical. But critically, it's substantially higher than Brenntag's operating EBITDA to sales margin of 7.5% in FY23.
Wow, 11.2% versus 7.5%. That's a huge difference.
Yeah.
Why is Azelis' operating margin so much higher than Brenntag's, despite their gross margins being quite similar? That really highlights something fundamental.
It does. And this margin differential isn't just about minor differences in operational efficiency. It's fundamentally structural. It reflects the core business models.
Wow.
Brenntag's overall profitability is diluted by its large essentials division. That division handles higher volume, lower margin commodity chemicals.
A little less specialized stuff.
Exactly. Those products, while necessary, require less technical expertise and naturally offer lower profit per unit. In contrast, the singular focus of Azelis and IMCD is on higher touch, technically demanding specialty products.
The value-added services pay off.
They do. It inherently carries higher margins because of the value-added services they provide. This specialized approach allows them to command superior operating margins because they're selling solutions, innovation, expertise, not just bulk chemicals.
So Azelis and IMCD are the true specialty pure plays.
That's a good way to put it. It validates the premium quality and higher profitability of their earnings streams compared to the more diversified players.
Okay, and what about cash flow and returns?
Right. Cash flow and returns. All three companies demonstrate the highly cash-generative nature of their asset-light distribution model. They consistently produce strong free cash flow.
Asset-light meaning they don't own huge factories.
Correct. They don't need massive capital expenditures for manufacturing, unlike their principals. Leverage levels are also comparable across the board. That reflects the common practice of using debt to finance their M&A-driven growth strategies in this consolidating market. It's a prudent use of capital when executed well.
So, wrapping up this comparison.
To put this into perspective for you, the learner, the this financial benchmarking, really underscores that Azelis and IMCD are the most relevant peers to study if your focus is on understanding the specialty value-added distribution model.
Rather than the broader chemical distribution market.
Exactly. They truly represent the high-quality end of the spectrum with superior operational efficiency kind of baked into their model.
Okay, the picture so far paints Azelis as a high-quality specialty player, skillfully navigating a complex industry, demonstrating strong competitive positioning. That's very clear now.
Good.
Let's dig into their financial track record. What does their performance look like over the past few years, especially leading up to this most recent period of economic flux?
Well, Azelis has truly established an exceptional long-term track record of profitable growth. It's really a testament to the success and resilience of its business model. Over the 6-year period from 2019 to 2024, the company has effectively doubled its size. Revenue grew from about $2.1 billion to $4.2 billion.
Doubled in 6 years. That's impressive.
It is. It represents a compound annual growth rate, CAGR, of an impressive 15.0%. And this robust top-line growth has been consistently fueled by that dual-engine approach we talked about.
M&A and organic growth.
Exactly. A powerful combination of disciplined acquisitions and steady organic growth, which actually averaged a robust 10% per year in the 3 years leading up to 2023.
10% organic growth is very strong.
Very strong for this type of business. And a defining characteristic of their financial journey has been the consistent and significant expansion of its profit margins.
Margins have been going up too.
Consistently. Their gross profit margin improved by 330 basis points. That's 3.3 percentage points, climbing from 21.2% in 2019 to 24.5% in 2024. Even more impressively, their adjusted EBITDA margin expanded by 340 basis points, from 7.8% to 11.2% over that same period.
Wow, from under 8% to over 11%.
Yes. This isn't just a minor improvement, it's powerful evidence of the company's value creation. It reflects significant operating leverage as they grow, a favorable shift in their business mix towards those higher value specialties, and the successful integration of higher margin businesses they've acquired.
So profits grew even faster than revenue.
Naturally, this margin expansion led to profit growth substantially outpacing revenue growth. Adjusted EBITDA, that key measure of operating profit, grew from $163 million in 2019 to nearly $471 million in 2024. That's a robust TGI of 23.5%.
23% profit growth per year.
Okay. And free cash flow has also been consistently strong, underscoring that cash-generative nature of their asset-light model. While it can show some volatility, related to strategic working capital investments.
Like building inventory.
Exactly. They generated a record $601 million in 2023, which then normalized to $342 million in 2024, precisely as they intentionally invested heavily in inventory ahead of an expected recovery.
Those are stellar long-term numbers, impressive growth, margin expansion. But our sources also talk about more recent performance, specifically fiscal year 2024 and the first half of 2025, which saw some distinct pressures. What exactly happened there? How did Azelis navigate those challenges, especially given the global economic headwinds?
Right. The period from early 2024 through mid-2025 has indeed been characterized by Azelis navigating a challenging macroeconomic environment, no doubt about it. However, they demonstrated significant resilience while also facing some near-term pressures on profitability and cash flow. It's important to acknowledge that for a balanced view.
Okay, so what did FY24 look like overall?
Fiscal year 2024 marked a crucial period of stabilization for the company. Their total revenue was broadly stable, increasing by 1.5% as reported. It was actually more robust, 2.6% in constant currency if you adjust for foreign exchange fluctuations.
Stable, despite the headwinds. That's pretty good.
It was a critical achievement. The strong revenue contributions from recent acquisitions successfully offset a modest organic revenue decline and those FX headwinds.
So M&A really helped cushion the blow.
Absolutely. And critically, the company reported a return to organic revenue growth in the second half of the year, including a positive 1.8% organic growth in Q4 2024.
The green shoots of recovery.
Exactly. Signaling a potential inflection point and the much-anticipated end of that industry-wide destocking cycle that had impacted so many businesses globally. This positive momentum then continued into Q1 2025, with Azelis posting a healthy 2.5% organic revenue growth, reinforcing that recovery narrative.
Okay, so the top line stabilized and started growing again. What about margins recently?
Right. Despite this stabilizing top line, recent quarters did reveal some pressure on profit margins. In Q1 2025, for example, the gross margin contracted by 77 basis points, and the adjusted EBITDA margin fell by over 90 basis points compared to the prior year.
Why the drop in margins?
Management attributed this contraction to two primary factors. First, an unfavorable business mix. Higher growth was coming from the relatively lower margin industrial chemical segment compared to life sciences in that specific period.
Ah, the cyclical part recovered faster temporarily.
Seems so. And second, a deliberate increase in operating costs. They had proactively increased these costs, investing in people, infrastructure, in anticipation of a faster organic growth recovery that, in reality, materialized a bit more slowly than expected.
So costs went up before the revenue fully caught up.
Exactly. It highlights a degree of negative operating leverage in the short term. A challenge Azelis is proactively addressing with a newly announced $20 million annualized cost-saving program.
Okay, they're reacting to it. Now, you mentioned working capital and cash flow normalization. Can you explain that inventory build again? It sounds counterintuitive to build inventory when things slow down.
It can seem that way, but let's talk about the working capital dynamics, because this is particularly insightful and I think often misunderstood by the market. The significant decline in free cash flow in 2024 wasn't a mistake. It was a direct result of a strategic decision to invest heavily in working capital.
Specifically inventory.
Primarily, yes. Building up inventory. Management consistently linked this investment to a positive buildup of the order book and a deliberate preparation for recovering demand across the business.
So they saw orders increasing and stocked up.
That's the narrative. Think of it like a retailer stocking shelves for an anticipated busy holiday season. They're spending cash on inventory now so they don't miss out on sales later.
Okay.
While this action temporarily increased their net working capital to revenue ratio and pressured cash conversion in FY24, it is fundamentally interpreted as a bullish signal. It shows management's confidence in a forthcoming cyclical recovery.
They're betting on the recovery.
They are. By building up inventory, they are positioning the company to capture that anticipated revenue growth without being constrained by supply shortages when demand truly picks up. Missing sales due to lack of inventory would be a far worse outcome.
Okay, that makes strategic sense. So they were essentially investing ahead of the curve, preparing for recovery, even if it pinched short-term margins and cash flow.
Precisely.
That requires a strong balance sheet to pull off without undue stress, though. How does their balance sheet look? Especially given this strategic investment and their continued M&A activity. How healthy is it?
That's an important observation. Azelis indeed maintains a robust and flexible balance sheet, which is absolutely crucial for supporting its M&A-driven growth strategy and absorbing these strategic working capital investments without jeopardizing financial stability.
So what's their leverage like? Debt levels?
As a result of their continued M&A activity and those working capital adjustments we just discussed, their net leverage ratio did rise. It increased from 2.5x net debt to EBITDA at the end of 2023 to 2.9x at the end of 2024. And it ticked up further to 3.1x as of June 2025.
3.1x. Is that high?
It puts them at the upper end of management's own target range, which is 2.5x to 3.0x. So yes, it's elevated relative to their target. However, and this is important context, the company has a demonstrated history of deleveraging following acquisition cycles.
They pay down debt after buying companies.
Exactly. For instance, they successfully reduced the ratio from 2.7x down to 2.2x during 2022. It shows a disciplined approach to managing their debt levels over time once integration synergies start flowing.
Okay. Any other balance sheet moves?
Yes, a key de-risking event occurred in September 2024. They successfully refinanced their primary debt facility.
Refinance, meaning they got new loans?
Essentially, yes. Azelis issued $600 million in senior unsecured notes and secured a new $600 million term loan. This transaction was specifically designed to refinance facilities that were maturing in 2026.
Pushing out the maturity date.
Exactly. By doing this, they effectively extended the majority of their debt maturity profile out to 2029. This not only secures significant financial flexibility, but also provides certainty. It reduces their exposure to short-term interest rate volatility and ensures they have ample capacity to continue pursuing M&A without facing near-term refinancing pressures. Very prudent move.
Good planning. And their available cash. Liquidity.
They maintain a strong liquidity position. As of the end of H1 2025, Azelis had an impressive $702 million in available liquidity. That comprises both cash on hand and their undrawn revolving credit facility, basically, a pre-approved line of credit.
So plenty of buffer.
Ample buffer for operational needs, strategic investments, and any unforeseen circumstances. It highlights a very prudent approach to financial management overall.
Okay, so the balance sheet seems strong enough to support their strategy.
It is. This balance sheet strength is critical. It allows them to pursue their prolific M&A strategy without being constrained by immediate financial pressures. It's really a testament to their disciplined financial management and a foundational element underpinning their long-term growth ambitions.
We've touched on their M&A strategy a few times now, emphasizing its importance and how it's supported by that robust balance sheet. Let's go deeper into how Azelis actually grows its business. Our sources explicitly call it a dual-engine approach.
That's right.
What powers these two distinct but complementary engines that drive Azelis forward? And how do they work together?
Absolutely. This dual-engine strategy is fundamental to Azelis' entire growth narrative. It perfectly combines a prolific and highly disciplined M&A program with targeted organic growth initiatives. This integrated approach is explicitly embedded in their stated value proposition of delivering consistent organic and acquisition-driven growth.
Okay, let's start with the M&A engine, the prolific consolidator part.
Right. The M&A engine, a prolific consolidator. Mergers and acquisitions are, without a doubt, the primary engine of Azelis' expansion and a core pillar of its corporate strategy. They strategically utilize M&A as their principal tool for several key things.
Like what?
Entering entirely new geographic markets, expanding into adjacent end market segments, and crucially, broadening that lateral value chain of complementary products we discussed.
Making their offering more comprehensive.
Exactly. It allows them to offer an ever more comprehensive suite of solutions to both principals and customers, making them an increasingly indispensable partner.
And the pace of this M&A is high.
The pace of this activity is truly a testament to a highly developed and repeatable M&A process. In 2024 alone, they completed 8 acquisitions.
8 deals in 1 year.
8 deals, which collectively added over $140 million in prior year revenue. This followed an equally active 2023, during which 7 acquisitions were completed, representing over $400 million in prior year revenue.
Wow, they're constantly buying companies.
It's a core competency. But this isn't simply a strategy of buying revenue for its own sake. It's a targeted approach. They're acquiring specific technical talent, gaining niche market access, securing valuable new principal relationships, and adding specialized product portfolios that, in turn, fuel the entire Azelis business ecosystem.
So it's strategic, not just empire building.
Very much so. The strategic rationale behind these deals is consistently clear and focused. Recent transactions, for example, they were aimed at strengthening their footprint in key European markets like Switzerland with Distona AG and Italy with ACEF.
Okay.
They also deepened their presence in the high-growth Indian market with the AZE.BR Group acquisition and made significant pushes into that incredibly attractive food and nutrition market in the Americas through platform acquisitions like Gilco Ingredients in the U.S. and Vogler Ingredients in Brazil.
Targeting specific markets and capabilities.
Precisely. By acquiring these specialized firms, Azelis can absorb valuable intellectual property, deep-rooted local customer relationships, and specialized market knowledge far more efficiently than they could ever achieve through purely organic efforts.
But integrating all these different companies must be challenging, right? Different cultures, IT systems.
Of course, M&A comes with integration challenges, bringing different cultures, IT systems, operational procedures together. It's never simple. However, Azelis seems to have developed a robust playbook.
How do they manage it?
Well, they often target those smaller tuck-in acquisitions, which are generally easier to integrate than large transformational mergers. They focus on preserving the acquired company's technical expertise and customer relationships, the things they bought it for, while seamlessly integrating back-office functions like finance and HR.
And plugging them into the Azelis network.
Exactly, extending Azelis' global principal network to the newly acquired entity. The key to value creation lies in giving these acquired companies immediate access to a broader portfolio of principals, a much larger customer base, and Azelis' advanced digital and technical infrastructure creates synergies that significantly enhance their growth prospects.
So they're not just collecting companies, they're integrating them strategically to fuel and enhance the larger ecosystem. Makes perfect sense for building that comprehensive service provider.
Right.
What about the organic side of the engine? How do they drive growth from within, complementing all this acquisition activity?
Good question. Complementing their aggressive M&A strategy, Azelis actively pursues several organic growth initiatives. These are specifically designed to deepen market penetration and continuously enhance its value proposition.
Okay, like what?
Well, innovation remains a fundamental cornerstone of this organic growth. That extensive network of over 70 application labs isn't just for show or just supporting M&A.
They're actively developing things.
Yes. These facilities serve as vibrant innovation hubs, constantly developing new formulations and applications for their diverse customer base. For instance, they might work with a customer to develop a new formulation that uses fewer, more effective ingredients, or help a client adapt a product to comply with new regional regulations.
Creating value beyond just supplying the chemical.
Exactly. This technical leadership not only helps them win new business and secure new mandates from principals, but crucially, it creates those high switching costs for customers who become deeply reliant on Azelis for their critical R&D support.
And the awards back this up.
Right. The consistent stream of prestigious industry awards they receive for innovation underscores the success and effectiveness of this strategy.
Okay, innovation is key. What else drives organic growth?
Digitalization is another key lever. Azelis is making significant and ongoing investments in its digital infrastructure. We mentioned the customer portals, the e-commerce platforms.
The ones with the 60% user growth?
Exactly. These tools are designed to do several things. Enhance the customer experience, making interactions smoother, more efficient, improve operational efficiency by streamlining processes like ordering and inventory management, and create entirely new channels for growth, reaching customers who prefer digital interactions.
Okay. Innovation, digitalization. What else?
Sustainability has also become a powerful organic growth driver and a significant competitive differentiator. Their comprehensive Impact 2030 sustainability agenda, their commitment to the Science-Based Targets Initiative, SBTI.
The ESG focus we talked about.
Yes. It's increasingly important as large customers and principals place a greater emphasis on ESG performance within their own supply chains. Azelis' industry-leading ratings from Sustainalytics and MSCI provide a distinct and compelling advantage.
Helps them win business with big companies.
Absolutely. Allows them to meet stringent procurement requirements, positions them favorably for long-term partnerships, differentiates their service offering in a market increasingly focused on responsible sourcing.
Okay, one more organic driver.
Finally, mandate and principal development. This is a key and very capital-efficient source of organic growth. It involves expanding relationships with their existing principals.
Selling more stuff from the partners they already have.
Essentially, yes. This can manifest in several ways. Gaining distribution rights for a principal's products in new geographic territories where Azelis already has a presence, or adding entirely new product lines to their existing portfolio for a particular principal.
Like the LangXS example.
Exactly. The expanded partnership with LangXS in the U.S. for its polyurethane dispersion products is a prime example of this synergistic growth. An existing, trusted relationship is leveraged for further expansion. It demonstrates that principals see Azelis as a reliable and effective channel to market.
So multiple levers for organic growth complementing the M&A. Very clear. And it's clear they have a very intentional and well-structured capital allocation framework guiding these decisions.
They do.
From where to invest their capital to how they return it to shareholders.
Right.
What are their specific priorities when it comes to deploying capital? What does this framework tell us?
Their financial decisions consistently reveal a clear and highly disciplined capital allocation framework. It's rigorously designed to maximize long-term shareholder value. There's a distinct hierarchy of priorities they follow.
What's number one?
The first priority is always given to funding organic reinvestment. This includes essential capital expenditures for that crucial network of labs, ongoing investments in their digital platforms, and other operational needs that fuel their
Feed the M&A engine. Okay. Number three.
Third, Azelis is committed to returning capital to shareholders through a progressive dividend. They propose a dividend of $54.9 million, or $0.23 per share, for fiscal year 2024.
Progressive meaning it tends to go up over time.
Yes, generally increasing over time, signaling confidence in future cash flow generation. Their stated policy targets a 30% payout ratio of distributable net profit, shows a balanced approach to shareholder returns while retaining sufficient capital for growth.
Okay. And the final priority.
And finally, balance sheet management is a constant focus. They aim to maintain that target net leverage ratio of 2.5x to 3.0x over the medium term. It reflects a careful balance between funding M&A and maintaining strong financial prudence, ensuring they don't overextend themselves and retain flexibility.
So organic investment, M&A, dividends, keep leverage in check. Seems logical.
It is, but this raises an important question for you, the listener. There's an inherent tension here.
Attention, how so?
Well, acquisitions, particularly when they involve entering new geographic markets or integrating less mature segments, can be temporarily dilutive to margins in the short term. The acquired company might have lower margins initially.
Right, integration takes time and money.
Exactly. And the market, which often scrutinizes quarter-over-quarter margin trends very closely, may penalize this short-term dilution without fully appreciating the long-term strategic value and the embedded growth potential these acquisitions bring.
So the market might overreact to a short-term dip.
Potentially. This potential misinterpretation of what is essentially a necessary investment in future growth, thinking it's a sign of deteriorating business quality, may in fact be a key source of the current valuation opportunity for you, the long-term investor.
Interesting. The market focusing on the short term may be missing the long game.
It's possible. In short, the market may be reacting to short-term noise while missing the long-term strategic brilliance.
That last point about market misinterpretation, short-term pressures versus long-term strategy, leads us perfectly into the valuation discussion. The report you've provided suggests a compelling disconnect, a fascinating mismatch, it says, between Azelis' intrinsic value and its current market price.
Yes, that's a key part of the thesis.
What exactly does the valuation analysis tell us? Why might the market be missing something here?
Well, the valuation analysis indeed points to a potentially significant opportunity for the discerning investor. It suggests that Azelis' fundamental strengths and its long-term prospects are not fully reflected in its current stock price.
How does it show that?
First, let's look at the historical de-rating Azelis has experienced. The company's valuation multiples have undergone substantial compression since their peak back in 2021.
2021 was a frothy year for many stocks.
It certainly was. For instance, its price-to-earnings, PE ratio, the share price relative to earnings per share, was a lofty 92.0x back then.
92 times earnings. Yeah, clearly unsustainable. This normalized to a much more realistic range of 19x to 28x in 2024. Similarly, its enterprise value to EBITDA multiple, which gives a fuller picture of value versus operating earnings contracted from over 30x in 2021 down to a much more modest range of about 10x to 13x in 2024.
So a big drop in the valuation multiple.
A huge drop. Now, while this derating impacted the broader chemical distribution sector, the analysis suggests that Azelis specifically appears to have been excessively penalized relative to its fundamental quality and its growth trajectory.
Okay. How does it look compared to peers right now?
Let's turn to a public comparables analysis comparing Azelis to its closest peers. This reveals, arguably, a clear anomaly in its current valuation. As of the latest available data, Azelis trades at an LTM EBITDA multiple of approximately 10.6x, LTM is last 12 months, and a PE ratio of around 18.7x.
10.6x of EBITDA, 18.7x PE.
Got it. How does that compare? Well, this places Azelis at a significant discount to its most direct and pure-play competitor, IMCD.
The one with a very similar business model. Exactly. IMCD trades at an EBITDA of approximately 13.2x and a PE of about 24.6x.
Okay, 10.6x for Azelis, 13.2x for IMCD. That's a noticeable gap.
It is. Given the striking similarities in their specialty-focused business models, their historical growth rates, and their best-in-class profitability, this valuation gap appears fundamentally unjustified.
Why would they trade so differently?
Well, one could argue for maybe a modest premium for IMCD based on its slightly longer track record as a public company, perhaps. But the current magnitude of the discount to Azelis suggests a relative mispricing by the market.
Okay, and how does it compare to Brenntag, the bigger, more diversified one?
Compared to Brenntag, Azelis trades at a slight premium. Brenntag's EBITDA is around 9.7x and PE around 15.8x.
So Azelis is slightly higher than Brenntag.
Yes, and this premium, unlike the discount to IMCD, seems well-deserved. It reflects Azelis' superior profitability metrics, particularly that higher EBITDA margin, its more focused specialty business model, and its historically stronger growth profile.
So a premium to Brenntag makes sense. The substantial discount to IMCD does not.
That's the argument, yes. In short, the market appears to be giving Azelis almost a commodity player discount, despite its clear, specialty-focused, high-margin profile. It seems to be placing it unfairly below its true pure-play peer.
It certainly seems like they're trading at a significant discount to IMCD, despite those similarities. That's a strong point for potential undervaluation.
But Is there any plausible argument, even a weak one, for why the market might be valuing them so differently? You mentioned IMCD's longer track record, maybe geographic mix.
Those are fair points to consider, absolutely. IMCD does indeed have a slightly longer tenure as a public company. That can sometimes lead to a perception of greater stability or a more proven story in the eyes of some investors.
Okay.
Additionally, there might be subtle differences in geographic exposure or specific end markets that could influence investor sentiment at any given time. However, when you really look at the underlying fundamentals, the strong organic growth, the consistent margin expansion, the highly effective M&A strategy, the robust balance sheet we discussed.
The core business quality seems comparable. Very much so. The magnitude of the valuation gap between Azelis and IMCD is still very difficult to justify based on fundamentals alone. Any perceived differences seem unlikely to warrant such a substantial discount. It points more towards a market inefficiency, perhaps, rather than a fundamental difference in quality.
Okay. What about private market valuations? Does M&A activity tell us anything?
This is a crucial piece of the puzzle, actually. An analysis of M&A activity within the specialty chemical distribution sector provides further indication of potential undervaluation in the public market.
How so? What are companies being bought for privately?
Despite public market volatility, private market valuations for high-quality specialty chemical assets have remained remarkably robust. The median EV/EBITDA multiple for specialty chemical transactions, actual deals being done in the second half of 2024, was 13x.
13 times EBITDA in private deals.
Yes, which is above the long-term historical trend for such deals.
Interesting. So private buyers are paying more than public markets are valuing these assets.
It suggests that strategic acquirers and private equity firms, who typically take a longer-term view of value, are willing to pay a premium for high-quality assets in this space. The significant disconnect between these private market transaction multiples around 13x and Azelis' current public market multiple of about 10.6x implies that the public market might be taking an overly pessimistic or perhaps just short-term view of the company's long-term prospects.
It seems like private buyers see more value than the public market. That's a powerful signal when evaluating potential opportunities. What about an intrinsic valuation model, like a discounted cash flow analysis? What does that tell us about Azelis' true worth?
A discounted cash flow, or DCF analysis, was indeed conducted in the report to estimate Azelis' intrinsic value. This is based on forecasting its future cash-generating capabilities and discounting them back to the present. Of course, it involves making several key assumptions about the future.
What were the main assumptions?
For revenue growth, the analysis assumed mid-single-digit organic revenue growth over the medium term. This reflects a normalization of end market demand and the company's continued ability to gain market share through its value-added services. This organic growth was then augmented by a conservative estimate for future growth from yet-to-be-announced acquisitions, acknowledging Azelis' prolific and value-accretive M&A strategy.
Okay, reasonable growth assumptions. What about profitability?
Regarding profitability, adjusted EBITDA margins were projected to gradually recover and expand back towards that 11.5% to 12.0% range over the forecast period.
Getting back towards their peak levels.
Exactly. Driven by several factors. Operating leverage on recovering volumes in industrial chemicals, the realization of synergies from recent acquisitions as they're fully integrated, and the benefits of their newly announced cost control programs.
And working capital, the inventory build.
For working capital, the net working capital to sales ratio was forecast to normalize back towards the company's historical average of 13–14%. This assumes the current strategic inventory investment cycle unwinds as demand recovers.
Makes sense. And the discount rate.
Finally, an appropriate discount rate, WACC, was used, calculated based on Azelis' capital structure, prevailing interest rates, and an appropriate equity risk premium for a company in this industry. A terminal growth rate of 2.5% was applied, reflecting long-term nominal GDP growth assumptions, a pretty standard conservative estimate for a mature but growing global economy.
Okay, so what was the result of the DCF?
The result of this DCF analysis indicates a significant upside to the current share price. It strongly reinforces the view that the stock is intrinsically undervalued based on its projected future cash flows.
So comps point to undervaluation, private deals point to undervaluation, DCF points to undervaluation.
Pretty much. What's fascinating here is that synthesizing all these valuation methodologies, public comparables, precedent transactions in the private market, and the discounted cash flow analysis points to a blended price target in the report of €21.
21 euros. And where is it trading now?
Significantly below that level, implying substantial upside, according to this analysis.
Okay.
So this raises that important question again for you, the listener. Are you seeing a high-quality compounder temporarily mispriced by the market? Is this a potential opportunity for long-term value creation? Based on the data presented in the report, it certainly seems plausible.
Okay, the valuation case seems compelling based on that analysis. But every investment, every business comes with its share of risks, right? It's crucial to understand what could potentially go wrong, even with a high-quality, resilient company like Azelis.
Absolutely critical. No investment is risk-free.
So what are the primary risks Azelis faces in its operations and growth? And critically, how are they actively working to mitigate those potential challenges to protect their business?
Understanding risks and their mitigation is just as important, maybe even more so, than understanding the growth drivers. It's about building that complete, balanced picture of their resilience and the robustness of their strategic approach.
Okay, what's risk number one? Probably the economy.
Yes, first let's address macroeconomic and cyclical risks. The risk here is clear. A significant portion of Azelis' revenue, that 37% from its industrial chemicals segment, is inherently tied to global economic and industrial production cycles.
So a recession would hurt them.
A prolonged or deeper than expected global recession could undeniably depress demand, leading to lower sales volumes and pressure on profitability in that segment. However, Azelis has strong, multi-layered mitigation strategies.
Like the diversification.
Exactly. The company's primary mitigation is its diversified business model. The large and inherently resilient life sciences segment, 63% of FY24 sales, serves end markets with that non-discretionary demand. It provides a substantial defensive ballast that cushions the impact of industrial downturns.
And the geographic spread helps too.
Definitely. Their broad geographic diversification across EMEA, the Americas, and APAC helps to smooth the effects of regional economic weakness. Operationally, they also demonstrated a willingness to proactively manage costs, as we saw with that $20 million cost-saving program initiated in response to the recent slowdown.
Okay, so diversification and cost control help with macro risks. What's next? M&A risk.
Yes, M&A execution and integration risk. Azelis' growth strategy, as we've hammered home, is heavily dependent on its ability to consistently source, execute, and successfully integrate acquisitions.
What could go wrong there?
Failures here, like overpaying for assets, failing to realize projected synergies, or significant cultural clashes during integration, could potentially destroy shareholder value rather than create it.
How do they mitigate that?
Well, the mitigation here is primarily their strong track record. Azelis has a long and successful history in M&A, suggesting a well-honed and repeatable process managed by a dedicated corporate development team. Their strategic focus on those smaller tuck-in acquisitions generally carries lower integration risk compared to huge transformational mergers.
Less likely to bite off more than they can chew.
Right. And the successful debt refinancing in 2024 has secured the necessary long-term financial flexibility to continue this disciplined strategy without immediate financial constraints putting pressure on them to do bad deals.
Okay. What about relying on their suppliers, the principals?
Good point. We also need to consider principal and supplier risk. Azelis' business model is fundamentally dependent on maintaining strong, long-term relationships with its key principals, its suppliers.
What if they lose a big one?
The loss of a major principal could certainly have a material negative impact on revenue and profitability in a specific market or region. The company's top 10 principals account for 32.1% of revenue.
32% from the top 10. That sounds a bit concentrated.
It does indicate some degree of concentration, yes. However, this risk is significantly mitigated by the depth and longevity of these principal relationships. They average an impressive 30 years for their top 10 partners.
30 years. That's a long relationship.
It is. And critically, the analysis highlights that Azelis has not lost a top 10 principal in the last decade. That's a powerful testament to the strength of its value proposition, the trust they've built, and maybe the high switching costs for these partners, too.
Okay. And they have many other principals, too.
Exactly. The risk is further diversified across a very broad base of over 2,800 principals, reducing dependence on any single entity. Plus, the value-added services provided by Azelis' labs create high switching costs not just for customers, but arguably for principals, too.
Okay. What about margins getting squeezed, operational risks?
Yes, margin and operational risks. Profitability margins could face sustained pressure from several factors. Raw material or operating cost inflation, an unfavorable shift in product or geographic mix like more growth from lower-margin industrial chemicals, or increased pricing pressure from competitors.
We saw some of that recently.
We did. As demonstrated in recent quarters, a mismatch between the timing of cost investments and the realization of revenue growth can also lead to temporary margin compression. Mitigation here includes active management focus on prudent cost control, like that $20 million program. Their long-term strategic focus on growing the higher-margin life sciences segment should also provide a structural tailwind for margins over time, and they closely monitor their conversion margin.
Conversion margin.
Adjusted EBITDA as a percentage of gross profit. It's a key indicator of operational efficiency, ensuring they're converting gross profit into operating profit effectively, managing overheads well.
Got it. Any other major risks?
Finally, as a global, digitally integrated company reliant on complex IT systems, Azelis is exposed to cybersecurity risk. A significant breach could lead to operational disruptions, financial loss, reputational damage.
A big risk for any global company today.
Absolutely. And the company itself explicitly identifies cybersecurity as one of its top business risks. To mitigate this, Azelis has what they describe as a robust cybersecurity framework in place.
What does that involve?
It includes deployment of advanced cyber defenses like intrusion detection systems, a comprehensive top-level information and cybersecurity management system, and regular mandatory cybersecurity training for all employees to foster a culture of security awareness and proactive defense.
Okay. So they're taking it seriously.
It appears so. Bringing this back to why it matters for our listeners, you can see that while these risks are inherent to operating a global, complex business like this,
They're not ignoring them.
no. Azelis has implemented multifaceted and thoughtful strategies to manage and mitigate them. This reinforces the overall resilience of their business model and their capacity to navigate challenges effectively. It paints a picture of a well-managed company aware of its potential pitfalls. Hashtag tag outro.
And that brings us to the end of our deep dives into Azelis Group NV. Quite a journey.
It certainly was. A lot to unpack there.
We've explored their unique innovation service provider model, seen how they leverage that extensive lab network, and their dual-engine growth strategy, combining prolific, disciplined M&A with strong organic innovation initiatives. We've navigated their financial journey through recent headwinds, understood their strategic investments in working capital, and meticulously analyzed why their current valuation might present a truly compelling opportunity for long-term investors, based on the report.
We've indeed seen a company that operates at that crucial intersection of manufacturing and innovation, meticulously creating significant value for both its suppliers, the principals, and its diverse customer base. Their resilience in challenging economic times, their strategic execution of a clear growth vision, particularly in that high-margin life sciences segment, and through disciplined, value-accretive M&A, all underscore a compelling narrative that goes far beyond typical chemical distribution. It's really a testament to building a business on solutions, not just sales.
So what does this all mean for you, the listener? For me, it highlights how, in a world often drowning in information, we sometimes overlook the foundational behind-the-scenes companies.
The enablers.
Exactly. The ones that actually make our modern lives possible. From the specialized ingredients that make the food we eat healthier and tastier, to the advanced components in the personal care creams we use daily. These specialized elements are everywhere.
Absolutely.
Azelis is a powerful reminder that often the most interesting and impactful stories are found in the most specialized yet critical corners of the global economy, the stuff we don't always see directly.
And it encourages us, I think, to think more deeply about how companies truly build competitive moats, not just through patented products, but through sophisticated value-added services, unparalleled technical expertise, and a disciplined approach to strategic capital allocation, even when facing significant cyclical pressures.
That comprehensive approach to value creation.
Exactly. That's what makes them stand out and arguably deserves a closer look.
Well, we hope this deep dive has given you a fresh perspective, and perhaps even sparked some new curiosities about the unsung heroes of global supply chains like Azelis.
Hope so too.
Until next time, keep learning, keep questioning, and keep digging deeper.